itself in the middle of Wall Street's private credit fears.
The private credit universe, the way that we think of
private credit is a much bigger market. Direct lending is
center of the storm around private credit. And
JP Morgan CEO Jamie Dimon issued a warning on the earnings call Tuesday. He said, quote, "I probably shouldn't say this, but when you see one cockroach, there are probably more."
Dear friends, today we're going to talk about something that moves trillions of dollars. That's on the lips of every major investor on the planet, and yet most ordinary people have never even heard of it. We are talking about private credit, a market that went from being an obscure corner of Wall Street to becoming one of the largest sources of financing in the world. And in recent months, that market is living through its first major crisis of confidence. Blackstone, KKR, Apollo, Blue Owl, names that might ring a bell as big investment funds for the wealthy, but what's happening with them right now affects all of us. Today, we're going to break down what these companies are, how their business works, and why thousands of investors are trying to pull their money out. Let's get into it.
The business model, making money from fees on capital managed.
To understand what's happening today, we first need to understand who these players are and how they are making money. Imagine you run a mid-sized company, not enormous, not publicly listed, but doing well. You need financing to grow, acquire a competitor, or simply refinance some debt. Who do you go to? For decades, the answer was simple, the bank. But after the 2008 financial crisis, banks became far more conservative, regulation tightened, and suddenly that gap in the market was left wide open. And that's where the big alternative asset management stepped in. Firms like Blackstone, KKR, Apollo, and Blue Owl raised their hands and said, "We'll finance those companies." And they started building private credit funds. How does it work? Well, in words of Mike Bird, editor of The Economist,
what private credit actually means, I think the broadest version of this is it's loans lent by firms that aren't banks, alternative asset managers often, and lending that's not done in the bond market. So anything that comes between those two things is fair game as the broadest definition of private credit.
So their game is fairly straightforward. These firms raise money from investors, pension funds, insurance companies, family offices, and increasingly high net worth individuals. With that money, they lend directly to mid-sized companies in what's known as direct lending. In return, they collect interest, typically between 8 and 12% per year. On top of that, the management firm charges both management fees and performance fees. But not so fast. This isn't simply lending money the way the bank does. The model has several layers. First, private credit is illiquid. The loans don't trade on any public market. You can't easily sell them. They are made to private companies and held to maturity. Second, because they are not regulated like banks, these firms can lend with far more flexible structures, sometimes with fewer guarantees, more creative terms, or to companies that banks would flat out reject. And third, here's where the real business lies. They don't just manage credit funds. KKR, Blackstone, and Apollo has businesses across virtually the entire universe of alternative assets. Private equity, real estate, infrastructure, insurance. So private credit is just one leg of the stool, a very profitable one, but just one. Blue Owl, on the other hand, is purer. It was born focused on private credit and lending to private equity-backed companies. With over $300 billion in asset under management, it has become one of the world's largest direct lenders. And how do these firms actually make money? Mainly two ways. First, the management fee, typically between 1 and 2% annually of the total assets under management. With hundreds of billions under management, that alone is an enormous amount of money, regardless of how the investments perform. Second, the carried interest, a share of the profits, normally at 20%, that they earn above a minimum return threshold to their investors. In short, dear friends, they build the casino, charge admission, and take a cut of every win. A beautiful business when things go well.
From origins to today, the evolution of the industry.
These companies weren't born as the monsters they are today. To understand where we are, we need to see where they came from. KKR is one of the oldest private equity firms in the world. Its founders essentially invented the concept of the leverage buyout. Their most famous deal was the acquisition of RJR Nabisco in 1989, a $31 billion transaction that shook the financial world and inspired the book Barbarians at the Gate. For decades, KKR was primarily a private equity firm. Buy companies, restructure them, sell them, or take them public. Private credit came much later. Blackstone started in mergers and acquisitions, then grew into private equity, real estate, and eventually credit assets. Today, it's the world's largest alternative asset manager, with over $1.2 trillion under management. Apollo Global Management always had a DNA more oriented toward credit and distressed debt, buying junk bonds from troubled companies at bargain prices and profiting when these companies recovered. Over time, they diversified into private equity and insurance, acquiring Athene Holding, a major insurer that gives them access to enormous flow of capital from insurance reserves. And Blue Owl, from the start, its focus was private equity and capital solutions for private equity funds. Younger in history, but not in ambition. Now, the key to everything. What happened over the last 15 years? The answer is simple. The era of zero interest rates changed everything. When central banks slashed rates to the floor after 2008 and kept them there for over a decade, investors were desperate to find yield somewhere. Government bonds paid almost nothing. Stock had already run up, and suddenly private credit was offering returns of 8 to 12% per year. Money started pouring in. The private credit market grew from around $400 billion in 2010 to over $1.5 trillion by 2025. And these firms weren't content with large institutional investors. They saw an ocean of money that they hadn't touched yet: individual investors, retail. And here comes the great innovation, and also the great problem we're about to get into. To attract money from individual investors, they created what are called semi-liquid funds. Unlike traditional private equity funds where capital is locked up for 8 to 10 years, these new vehicles promise to allow investors to withdraw their money every quarter within certain limits. The pitch was, access the same products as the big pension funds with a little more flexibility. The promise was so attractive that retail money started flooding in. Blue Owl, for instance, ended up with close to 40% of its assets coming from individual investors. As for the different business lines, today, these firms are full-blown financial conglomerates. Private credit is central, but they also run private equity, buying and selling companies, real estate, investing in commercial and residential properties, infrastructure, financing highways, airports, energy, and insurers, where Apollo and Blackstone have made major moves because insurance reserves are an enormous and stable source of investable capital. Each business line has its own dynamics, but they all share one thing in common: raise capital, deploy it, and collect fees along the way. The question is, what happens when the capital wants to leave?
The perfect storm: redemptions, liquidity, and the software problem.
Dear friends, we've arrived at the heart of the video, because what's happening right now in the private credit market is fascinating and deeply revealing about how money actually works in the real world. Everything started going sideways in November 2025, when Blue Owl began restricting withdrawals from one of its funds.
Doesn't all of that argue that maybe that this is a product that retail is not ready for, that there's still confusion? And we see in other industries like tobacco, for example, it got highly regulated because courts there said it wasn't enough that experts understand this. If there are people out there who don't understand this, then this product should have more eyes and attention and maybe regulation around it.
In February 2026, it took an even more drastic step. It closed the quarterly redemption window of its OBTC2 fund, a vehicle aimed at individual investors with around $1.7 billion. In parallel, it sold assets worth $1.4 billion to return cash to those waiting out. The market shuddered, and then the domino effect was unleashed. Blackstone faced $3.8 billion in withdrawal requests, nearly 8% of the BC Red fund. To cover them, The firm injected $400 million of its own money. BlackRock restricted redemptions from its $26 billion private credit fund, and Morgan Stanley received requests to withdraw almost 11% of its fund. But now comes the crucial question, and this is a critically important distinction that the media tends to blur. Are we facing a liquidity problem or a real credit problem? Pay close attention.
Liquidity versus credit risk. What are the actual threats?
A liquidity problem means the fund holds good quality, perfectly healthy assets, but can't sell them quickly enough to return money to investors who want out. It's like owning a fantastic apartment in a great neighborhood that worth a fortune, but you can find a buyer in 2 days. The asset hasn't lost its value, it's simply not liquid. The private credit fund holds loans to companies that are paying their installments normally, but those loans don't trade on a public market. If many investors want to exit at once, the manager has to sell those loans in a secondary market, usually at a discount. And if the sales are rushed, it can create a negative spiral. A real credit problem, on the other hand, is something far more serious. It means the companies inside the fund are in trouble. They can't pay their debts. The loans are deteriorating. The real value of the fund is falling. This is no longer a question of time or liquidity. The money may have genuinely evaporated. So which one are we in? The honest answer is both, at least partially. In many funds, the initial problem is mainly one of liquidity. Individual investors who aren't used to having their money locked up have been spooked with the headlines and want out. Not necessarily because the fund is performing badly, but out of fear. As John Gray, Blackstone president, put it, quote, "If a firefighter wants to have their $25,000 back, they will be able to. Panic happens when people believe liquidity is unavailable." End quote. But here's the second problem, and this one could have real credit consequences. Private credit has enormous exposures to software sector, particularly SaaS companies, or software as a service. These companies, with their recurring revenues and high margins, were the favorite assets of private credit funds. According to S&P data, software and technology represents around 25% of the private credit market. Blue Owl, at certain point, had between 55 and 70% of certain segments invested in software. And what happened to software? Artificial intelligence is tearing it apart. AI tools are beginning to replace workflows that previously required expensive subscriptions to specialized software. Software companies' valuations on the stock market fell between 20 and 30% from October 2025 to February 2026. And if software is worth less, the loans backed by those companies are worth less too. UBS estimates that in a scenario of aggressive AI disruption, default rates in the US private credit could climb to 13%, 3 times higher than projected for conventional high-yield bonds. And the default rate among private credit corporate borrowers already hit a record 9.2% in 2025. Actually, the term SaaSmageddon has recently been coined. By the way, you can watch on YouTube the episode 1 of Framecast addressing this topic. This is no longer just a liquidity problem. If the debtor companies start failing because AI is hitting their business, private equity funds will face real losses. And investors who put their money in expecting 9% annual returns could find that actually part of their capital has genuinely disappeared. The executives of these alternative asset management companies have come out to say their software exposure is under control. Other managers have tried to reassure the market by pointing out that their loans are backed by profitable companies with positive cash flow. But the problem with private credit's opacity is precisely that. Nobody knows exactly what's inside the fund. It is, simply put, like banks without banking regulation.
Conclusion.
Dear friends, let's close with the million-dollar question. Is this the beginning of the end of private credit, or simply the first serious bump in the road for a market that's here to stay? My reading is what we are seeing is a painful but necessary correction. The private credit market grew too fast, with too much concentration in one sector, software, which now faces the greatest technological disruption in its history. And the democratization of access to liquid products for retail investors created a structural tension that was always going to snap sooner or later. The big managers will survive. Blackstone, Apollo, and KKR have rock-solid balance sheets and diversified businesses. But the model of selling illiquid products with promises of semi-quarterly liquidity to a retail investor, that model needs to be redesigned. As for the real credit risk, we'll be watching closely, because if software companies with private debt start defaulting in chain reaction, what looked like a liquidity problem could become something far more serious. What is clear is that private credit is no longer that obscure corner of Wall Street only known to major individual investors. It's now at the center of a global debate about financial stability, regulation, and the future of private markets. That's all for today. I'm Alex Ben, and you've been watching Flavecast. See you soon in the next episode.